Hello, everyone, and welcome to Charting Forward 2023. This is the first of our market outlook discussions through the course of this year. 2022, obviously a challenging year for investors, a bear market for stocks and most risk assets, some key names down 30, 40, 50 plus percent. A lot of newer investors in the last couple of years had their first taste of a raging bear market phase. So where does this leave us as we begin 2022 and start to look forward, chart forward, as it were, through the course of the next 12 months of trading? We have three fantastic experts along with us today to sort of try to piece those pieces of the puzzle together. Mish Schneider, who's the Director of Trading Education at Market Gauge, coming to us from Santa Fe, New Mexico. We have Greg Schnell of Osprey Strategic coming to us from the Phoenix area. And then we have Tom Bowley from the East Coast at our earnings beats, giving us a take on the markets as well. You guys, welcome, and thank you so much for being a part of our first market outlook of the year.
Thanks, Dave.
Yep. Thanks for having me, Dave.
Yes, thank you.
Yeah, it's a pleasure to chat with you guys. What we wanted to do with this one is keep it relatively unstructured. We've had just a really good conversation so far this morning about just things we're seeing and things we're hearing, and everyone should know what's really cool about a group like this is the moment we started talking, we're bringing up charts and comparing notes, and it just really reminds me what how great it can be to bring a group together and just think about what we're seeing and what we're hearing and compare notes a bit. So thanks, guys, for doing that with me. Let's kick it off here as we look forward through 2023. Let's start big. And my first question to each of you, we can go around the horn here. Do you have a target for the S&P for the end of this year? And if so, what is it? If not, that's fine too. And if not, and either way, really, what do you see? What are you expecting as you look forward through the course of this year? What should investors be looking for? Mish, can you start us off? How would you answer that?
Well, I really have sort of a focus for this year based on a lot of what happened in the late 70s when the market did have a bear market after that recessionary period, 74, 75, 76, and then kind of hit a trading range while commodities started to shine for all host of reasons. And I think the same thing for this year. Do I know exactly where the S&P is going to end? Of course not. But do I think that we're somewhere between 3,200 and 4,200 as our sort of established range? Well, obviously about to test the upper regions of that. That's kind of where I'm at right now in terms of the equities. As far as the commodities, we actually have a situation that could turn out to be even more inflationary than the 70s, because in the 70s, it was only focused on a few countries. And now we have it more on a global basis. So I'm looking at the super cycle to start. That doesn't necessarily mean a crash, a huge crash in equities, but it definitely will mean that things will have to stay stagnant until we start to see some real growth coming from wherever that might be.
Greg, Mish mentioned commodities. When you think about the S&P 500, we'll get to sector plays and non-equity equity asset classes in a little bit. But when you're looking at the S&P, what's your outlook for this year? Just high level, what are you expecting?
You know, there was just so many charts that started to base in October. They took a December dip and pulled back, and I like the higher low setting up now. So I'm way more optimistic, and I'm getting so many charts that are breaking out to the upside, including the US dollar breaking down. So I'm actually expecting a bigger picture of S&P well up into the 4,500s. I'm not a real prognosticator for a future target. I literally play it week by week, but I expect us to blow through the top of the range. So.
Very, very interesting. Tom, how would you answer that same question?
Yeah, I'm pretty bullish as we go into 2023. I think that's a pretty big reversal from where I was to start 2022. We had gone up so much in 2020 and 2021. I thought maybe we'd have a reversion to the mean in 2022. I was looking for possibly 3,500 to 3,800 in that range at the beginning of 2022. And I think we got down to 3,491, which is pretty close. As we were talking before the show started, one of the things I do a lot of research, and of the last 11 bear markets, I think it was 6 of them that have ended in October. And this last October's low, I think, was on October 13th. I'm seeing a lot of accumulation that's been taking place. I think that gets back to Greg's point a little bit as far as a lot of these bases that have been setting up. The biggest thing for me and the biggest challenge, I think, in 2023 is really growth versus value. And I know we're going to talk about that a little bit later. But I think what the Fed does and where interest rates go, I think will make a big difference as to which area of the market outperforms. But I do think we go higher. And I've put a target on the S&P 500 at 4,700. But I would not be at all surprised to see us an all-time highs sometime later this year.
So I think I know the answer to this, Tom, but would you say the bottom, we've seen the bottom in the S&P at this point?
Yeah, you know the answer to that one.
I just need to get it on the record here, Tom. Okay, so we can look back to this. But it seems like, I mean, and you, I mean, to your credit, back in June, started making some arguments, which I very heavily refuted on our StockCharts blogging platform. You were spot on. I mean, just recognizing the beginning of that bottoming pattern. So in your opinion, right? I mean, we've seen the bottom for the S&P. I don't think you would see us undercutting that 3,500 level at this point, right?
I don't think so, but I wouldn't rule it out. I mean, I think that a lot's going to come down to the Federal Reserve. I think that the Fed has definitely changed its tune a little bit in the last several months. It started off just wanting to see some progress in terms of some of these inflation reports. And then after we started to show progress, they said, well, we want to see a series. And then we started seeing a series. And then they said, well, we need to see inflation start heading back toward its target of 2%. So it's like everything's been changing every time something comes out. And I think that's put a monkey wrench in a lot of the stocks, especially the growth oriented stocks. They struggled in the fourth quarter. They went nowhere. The QQQ basically was flat in the fourth quarter, while the Dow was up 17%. So obviously there was a different shift. And I guess you can take that a lot of different ways. Some might look at the growth stocks being so, poorly performing and say, well, that's going to be a reason why we continue to go lower. But I actually find it as a positive that you got some of the most heavily market cap weighted stocks in the S&P 500 that are struggling so badly. And yet the S&P 500, gained a pretty nice amount in the fourth quarter. So it's telling me that there's money that's rotating. It's not leaving the market. It's rotating. I think that's bullish. And I think we go higher.
It's funny when you think about 2022. I'm so used to calling it a bear market, which I think it was by any loose definition. It certainly was, but there are plenty of stocks that actually had really good 2022s. I mean, it's a certain type of stock that had a really tough year. Greg or Mish, either of you disagree, or either of you feel strongly that we see a new low before 2023 is over?
I'll jump in. Well, no, I don't feel strongly about a new low. What I do feel strongly about is, I mean, you talk about, let's pick up on the Federal Reserve conversation. They came up with a new term, super core inflation, which is looking at core inflation without looking at the housing market. And some even say, let's extend that further and not look at the healthcare market. So essentially, defining the definition of inflation is one of the reasons why I'm so darn bullish. Not equities, not to mean that we can't see rallies along the way, but definitely more in the commodity space, definitely more in the gold, precious metal space, because the Federal Reserve, the more they talk, the more it's apparent that people don't believe what they say. And they've certainly have been hardly proactive. They've been reactive. We've seen these yields fall over the last several months, as Tom pointed out. So I'm going to go back to, regardless, if we go in history, what happened is, if we go back to the 70s again, the Dow went from 600 to 1,000 for like 15 years it went sideways, basically. But the range was 600 to 1,000. And then it took really not until 1982, after really inflation's back was broken, for that Dow to take off. And I think we're still in a period here where we'll see a trading range and not necessarily a crash. And yes, he mentioned the dollar, Tom, which is a great point, which is another reason why I'm so bullish in commodities, because I think the dollar could potentially free fall further. So my perspective is, like I said, not necessarily, oh my God, I'm so bearish equities, but I think those can just kind of flatline, have some periods of excitement like we're seeing now. But if you really want to catch the big trends this year, don't lose track of what's happening in energy, food, and in the metals.
Greg, I'm going to ask you about energy in a few seconds, but I was trying to keep up with all the chart. You were mentioning so many great charts to try and bring up, Mish. This is our long-term chart of the Dow, which is in our historical chart gallery. And this is the period you're talking about, right? We first reached Dow 1000 in the mid 60s. Then it took us 16, 17 years to finally break to a new high there in 1983 off the 82 low and sort of pushing to the upside. Greg, when you're thinking of the commodity space, energy, obviously one of the big stories, if not the story in the first half of the year, was the strength in energy. You've had a bit of a retrenchment. Crude oil, I mean, not too far off of lows here recently, but a lot of energy stocks starting to work. Is energy leadership a theme we'll be talking about later in the year, or is that something that was a previous story that's no longer around?
The presentation for ChartCon 2022 was all focused on the energy crisis. And really, I continue to think that that's been a problem and will be a problem. I'm starting to see the rotation back into that energy crisis theme across different sectors, but included in that would be a copper theme for wind and solar. And and when I look at the oil, we've been talking about the low inventories for a while, and you can try and buy the rallies, but they just kept breaking down. And so I think one of the things I'm expecting here is, if this is the start of the next bull leg, that energy will not be left behind. It will be a huge, important component because we're way too short in inventory. So I would expect energy to really, the alpha it had in 2021 going into 2022, I expect that to continue in 23. When we start to need energy on scale for all of the stuff in the higher, we were worried about Europe and Asia, and now both of those look like they're going to be okay. I think if they're not having recessions, we're popping higher, and that's going to really put pressure on oil to the upside. So I think the S&P enjoys that ride for a while, and then all of a sudden we start to figure out that this commodity price expansion is going to be much more difficult to deal with than we want to think about.
Tom, can I bring you in? Because when I think a lot of investors, particularly newer investors, are sort of programmed to think a bull market means you need to buy growth stock, right? You need to buy technology and consumer names. You need to buy Amazon, Tesla, the ARK names. Like, these are the things that work in a bull market phase. The last, 12 to 18 months have been sort of the opposite, right? Where you've seen those sorts of names struggle quite a bit. Even as things are rotating higher, you're still seeing value stocks outperform. This is sort of the chart of interest rates, but then value over growth in that second panel down. When you're looking now, and you mentioned you're pretty bullish on things, how would you think about allocating to sort of those traditional leadership names? I guess I would think like growth stocks, the Microsoft type of name, Apple names, emerging technology, versus industrials, Boeing, energy types of names that have been doing better recently?
Well, I think most bull markets will lift all boats. So I kind of like everything going forward for the most part. I just think you're going to
everything rally. I love it.
Yeah. But obviously not everything's going to outperform the S&P 500. So I'm looking for leadership. And right now, clearly that's not the large cap growth names. But if you pull up a long-term chart, say 10, 15 years, Dave, weekly chart on something like the IWF, IWD, just large cap growth versus large cap value, what you're going to end up seeing is almost like we've had this huge move to the upside. 10 years, 20 years, whatever.
10 years. So here's 10 years of the ratio, growth versus value.
So in 2020, what we were dealing with was rapidly declining interest rates. And my prior career, I was a practicing CPA. So I did valuations. And when you get rates that are dropping down to near zero, and you've got companies that are growing their earnings rapidly, like many of those large cap names were back in 2020, what you get really is just this straight shot higher in terms of what those valuations are. And that's what you see clearly on this chart in 2020. Well, that all started to change. And when we saw the interest rates really start to pick back up in 2022, you can see that what we've done is really, it's more of a reversion back to the mean. I think the long-term picture is usually better for growth stocks than for value-oriented stocks. And so I think we're going to get there, but I just don't know if it's in the first quarter or if it's later in the year, or maybe we go through another year where value outperforms. I think the huge outperformance that we've seen in value, especially in the fourth quarter, I think that's mostly behind us. But I wouldn't be surprised if in the first quarter we still see value outperforming. Again, for me, it comes back to the Fed. I think once the Fed has kind of gotten out of the way of the market, I believe the 10-year Treasury yield will dip back into the twos. I don't think we're going to see zero, but I do think we'll go back a little bit lower because we got no issues in terms of a overly strong economy. And so I think interest rates go back down, inflation starts to come back under control. And I think that's an environment where growth stocks can pick back up again. So I would say at some point in 2023, I like the growth stocks. I certainly would be allocating something to growth right now just because of the chart that you had shown, where we went back, we reverted back to that mean. This has been a horrible year for growth stocks. And that's actually when you want to be thinking about, getting a little bit more weighted in that area. So I like everything to go higher, but I like growth over value.
To follow up on that, Tom, because I know you have a couple different hats. Hopefully, other than your Carolina Panthers hat you're wearing at the moment, I know you have a CPA hat that you could put on, right? So a lot of people, when you see growth stocks that have come down so much, you talk valuations and the fact that obviously, the future earnings potential all of a sudden becomes a lot more attractive. How do you reconcile the fact that valuations become more attractive, but that happens when the charts are uglier and uglier, right? It's like they're more attractive valuation-wise because the trend is down. So how do you reconcile your CPA hat and your trend following hat, which I think is a pretty powerful one as well?
Yeah, I think, when you're looking at the market, one of the things I really don't like to focus on, I see a lot of technicians looking at PE ratios and how PE ratios back in 2000 were X and now they're X and try to compare because we're in two different markets. I know from having done valuations back in 2000, the 10-year Treasury yield was, somewhere around 6 or 7%. And, in 2020, we were down near zero. You can't compare PE ratios. You can't expect PE ratios to be the same with interest rates near zero as they were when interest rates are up in 6, 7% range. Number one, investors have opportunities to invest elsewhere. So when rates are at 6 or 7%, you can go out and you can buy some bonds and you can have guaranteed returns that are much higher. In a low interest rate environment, you really don't have those alternatives. So more and more money, I think, flows. And I think it makes sense that these growth companies are much more valuable in a low interest rate environment. So using my accounting, my fundamental background, I know that if rates do come down, that should benefit those growth stocks. And then I try to wait from a technical perspective to see that turn on a relative basis. So that's what I'm kind of watching for in 2023. I think we go higher. I just don't want to be too heavily weighted in growth until they start to show leadership again.
I love that point. You meant there are so many indicators like that. The one that comes to mind for me, there's an old indicator we used to use called the mutual funds cash to assets ratio. And it used to be this really good measure of whether mutual fund managers were buying stocks or basically building up cash reserves. But the problem was that indicator basically went to 0 years ago because interest rates are so low. It's like you couldn't get anything for your cash. So instead, they would rotate to higher yielding stocks. And so the indicator it didn't have the same historical value that it did. And I think that certainly can happen. I mean, the market structure certainly changes. Mish, you've mentioned commodities a number of times, so I want you to give you an opportunity to just talk about the relationship. And what I'd like to think about is just the relationship between stocks and commodities. I think for a lot of people, when they think of adding risk, it's adding or subtracting to equities because that's sort of the main vehicle they would use. You've mentioned sort of being bullish on the commodity space. Where would you particularly be focused as we begin the year? And how would you play that? And maybe as an advisor, as an individual investor, what levers would you pull? Is it futures? Is it ETFs? And kind of how would you think about it?
Well, I definitely prefer futures, but most people in our universe who are in the older generations are much more comfortable trading ETFs. So I talk a lot in ETFs so that my audience understands what I'm talking about. In terms of right now, I mean, one of the things that we were talking about before we started recording was this 80-month moving average. And I want to bring it up because in terms of some of these growth stocks, they have broken below their 80-month moving average, which is significant because it's sort of the breakdown of a business cycle that goes on anywhere from 5 to 7 years. And we're seeing just the reverse of that in a lot of the commodities, and particularly the food commodities, obviously in a lot of the energy and oil commodities, and definitely in the precious metals. The other thing we were talking about before, so it's worth repeating, is that what was happening over the last several years up until this past year, and even so, even in 2022, but I think could change in 2023, is that commodities, when they looked really horrible, were the best buy. When they looked amazing, were a great sale. And a perfect example of that is what happened in February when the Ukraine war broke out with Russia. Wheat and everything flew off the charts, and that was your sell opportunity. And so I think when we start to see that reverse, as we already are seeing in miners and gold, particularly gold leading everything, is when strength is being bought as opposed to sold. Now you know you have a real sea change. So if you're looking to just start investing now, I actually really believe gold is trading around $1,900 an ounce, if we are going to talk in futures. It was really fluctuating between 16 and 1850 for the last couple of years, just sort of rounding off. This over 1900, if it holds here, you have a pretty low risk. If it starts to break down and back under 1850, let's say, maybe not so much, maybe I'm early or maybe I'm late. But nonetheless, if it holds here, I don't see any reason why we can't go to 3,000, 3,500. That's what I'm looking for in gold. And I know it has not such great ramifications, but if we go cyclically, the commodities were dead for years. And that's why everybody was focused on equities. And now most people don't even really understand how to trade commodities. And I've been saying for the last 2 years, actually since 2019, it's about time you learn, and it's so much easier to do because of ETFs. And so, yeah, that's kind of what I'm thinking. And I just want to, as Tom was talking, I was also thinking about the growth stocks. And again, going back in history, the nifty 50s, they were all the rage throughout the 60s, right? And then all those big corporations, Gulf and Western being at the top of the heap there, were broken up, corporate monopolies, things like that. Now, I'm not saying that's necessarily going to happen to an Amazon and Google and Apple, although are threats. But those all are now in down cycles. And that doesn't mean they can't trend higher and then go lower and flatten out. But right now, I just don't see that as the future growth and what's going to pull us out, even if interest rates eventually do come down, which I don't think they're going to do for a while. I think we have to look elsewhere for a growth. And I hate to sound a little bit mad here, but some of that disruptive tech could be more interesting, and particularly digital. That's where we're going, is more into the digital age. That's where I'm looking for maybe 2024 as we start to get through this super cycle of commodities that I still see happen.
Yeah, it's so interesting. And a number of, I think most of us met John Markman, who was at ChartCon 2022, which you guys all thankfully were participating in. John's fantastic. And one of the books he wrote was called Fast Forward Investing, thinking about sort of long-term themes. Greg, you did a really good special event. I forget if that was last year or the year before on EV, and just thinking about electric vehicles and the implications of that. When you're looking, Greg, at the commodity space, gold and again, being in general up in Canada, energy, basic materials, a core part of the economy up there. When you see the strength that we've seen on something like gold off of the lows, how do you approach it going forward? Has it had its run, in your opinion, or is this an emerging theme that we would want to play? And how would you play it in terms of gold stocks, some other vehicles?
Well, if you pull up the gold chart with a weekly chart with PPO on it, you've got it on the screen there. But one of the things that happened was the PPO actually made a 5-year low just in that October time period, right down there in the bottom. That was a stunning place to get long gold. And it also happened to be the flip in the US dollar. So we saw a really nice correlation there. And on the US dollar, it's breaking the huge uptrend line this week. That's the same thing that we saw both in the 2009 low and the 2002 low, that there were big trend lines breaking on the US dollar as the market started to rally. So I particularly like the setup here for commodities higher, US dollar lower. And the CRB chart on a weekly, also with that same PPO on it, tells us something about what Mish said, which was the super cycle. And one of the things I did a long time ago was I thought, when something has a really high PPO, I want to go short that. And it was like That's a pretty quick lesson in what not to do. When something has a lot of momentum, don't try to short it. And so this PPI reading for the CRB, if you open that chart to 30 years, it's like the highest ever wave we've seen. It's so big, and it just stands out, telling you that this is real. This is a big move in commodities.
Yeah.
And on the next low, you want to be a buyer. So where are we now? That PPO is sitting right at 0. And any sort of turn up here just says, wake up and smell the coffee, because this is coming at us fast and hard. And I really have been struggling with why energy's been weak for the whole year. And it's basically just been waiting for this bull market to start. So I'm getting all of those other signals, and I think commodities will be in huge demand as we go forward, because we have so many governments trying to stop their growth. And it's just like, literally, you have no idea how much more difficult it's going to be in the future when commodities are higher priced, because we've tried to stunt their growth. So
we were talking just before, and this is a question I actually got recently on the final bar, and I'd love, Greg, if you could help answer, and if anyone else wants to weigh in as well. You know, a lot of times I'll get the question where the energy stocks started to look really solid, right? Kind of rotating higher. SLB, others kind of, you know, at or near 52-week highs again. But crude oil prices actually have not been going higher at the same time. How do you reconcile that, and how do you relate the trend in oil as a macro call versus the individual stocks, a lot of times, which, you know, as we've seen recently, can kind of diverge from, I guess, the underlying commodity?
I think if there was a case for fundamentals versus technicals, oil has been it, because there's been no inventory, and every fundamental analyst has expecting oil to go higher and higher, and yet it has not been able to do so. And I think the big thing for me is you want to buy oil near the lows. You do not want to wait for oil to hit $120 and then start to add to positions. That's just going to be a very difficult trade. So I like the base here, and you've got a horizontal line at $75. That just happened to be where we closed 2021 at. And then 2022, we went all the way up, but all the way back. And to me, that's the new floor. So I want to start to watch oil rise from here. And if we're entering our next bull market, we're about to step into commodities demand in China, in Europe, and in America. Charts like BMW are all starting to break out of their bases. So German automakers and all that kind of stuff, their businesses were stifled when energy costs got so high. So I really like the setup here for oil. And again, we've drained the strategic petroleum reserve quite significantly. It's not empty, but we've drained it a lot. So I would just expect that isn't going to be the buffer we had in 2022. And so we're going to end up having to face the music of a bull market with a bull market in commodities. And copper's breaking out, the steel miners are breaking out, iron ore is breaking out, gold's breaking out, oil's next on the table.
And Greg, I mean, to your point, which, by the way, I agree with everything, and I'm getting ready to buy oil again. You know, and I'll get back to the point in a second, but natural gas is dead. That had its run. I don't care about it anymore. But we had an unbelievable year trading natural gas, and also Scorpio tankers and things like that. So now you're absolutely, I couldn't agree with you more, Greg. Right now, looking at around $80 a barrel would be a good confirmation that the low is in. I think it's going to be an oil controlled in terms of the energy going forward. And I do believe that we still have what we have in commodities that a lot of people who don't understand commodities need to understand is that for all the years leading up to COVID, there was such low production of everything. And that's why we're in this situation. Because there was low production, because prices were so cheap. The whole reason for commodities markets to exist started with the corn market as a way for farmers to hedge when they had a good crop versus a bad crop. And so now everything being so much amplified because of the audience space, because of the number of speculators, we had this huge period of low production and not such great demand. COVID showed when we came back, the demand increased. And now, as Greg mentioned, China coming back, but also geopolitical situations. There's flare-ups all over the place. And I keep looking at them like little sparks, and then they die down, little sparks, and then they die down. But everything is setting the stage because commodities are so emotional and because countries need them and governments buy them and governments give stimulus to support people who can't afford them, that's all right there. That's why oil could lead the charge, or at least be finally the key to ignition for everything else we just talked about in terms of food and precious metals and even industrial metals.
Key to ignition. I see what you did there, Mish. Tom, can I bring you in here? Because one of the names you and I have talked about a number of times in recent years is Tesla, right? And the EV space, which, it has certainly struggled. Tesla's sort of a great example of an amazing chart that has now rotated and become one of the more negative charts here recently. When you see Tesla around 120, are you generally speaking, are you bullish on the chart here? And if not, what would you need to see to be more constructive on the name here?
Well, I'm going to pull one of the techniques that's used in a presidential debate. And I'm going to say, can I go back and respond first to the whole?
There we go. Thank you. Do it.
I want to talk about gold for a minute.
Yeah, please.
I'm not a fan of gold, and I'll just show a pretty simple chart why. If you pull up a long term, let's say 50, 75 years of gold, dollar GOLD relative to the S&P 500, and just show that line chart for the last, like I said, 50 years, maybe monthly. But when we go through bull markets, secular bull markets, think 1980s, think 1990s, look at the relative strength of gold from 1980 through 1999. It went straight down. The only time it had any outperformance versus the S&P 500 was during periods where we had excessive volatility, like the 1987 market crash. Then we saw a little bit of a blip up in gold. Yeah, right there. Then we went through a bear market, secular bear market from 2000 to 2012, and the market was much more fearful. We had a lot of volatility in that period, and you can see gold was a major outperformer. What we've seen since 2012, and it was 2013, I think, when the S&P 500 took out the highs from 2000 and 2007. Yeah. Since that bull market began and we got that breakout, gold has been a steady underperformer. The only time that we've seen really good relative strength is when we've had periods of volatility at the end of 2015 into early 2016, the pandemic in 2020, and then, of course, in 2022, when we've had the cyclical bear market. So I believe if you believe that the rates are going to come back down a little bit, if you think the Fed's getting close to the end of its fight against inflation, then I think you have to be thinking that the S&P 500 is probably a better investment than gold. I'm not saying gold doesn't go higher. I think it could, but I just think the S&P 500 is going to be a better investment. And that's the way I would look at it. Do I think gold can outperform the S&P 500? And I don't think it's going to. Now, if you're bearish and you think the market goes lower again, then yes, I would say gold is probably going to be your better investment. But I just don't see that. So I just wanted to make that point.
Really good long-term chart. No, I appreciate you sharing that. And that's actually really helpful to think about the longer-term ratio. Greg, did you have something to add?
Yeah. So right at that 2002 low to 2012, that's exactly where we sit. We're sitting here at the edge of the next commodity bull market, and we are going on a run for the roses here. So this is not the place. And you see us sitting right on the red line that worked so well on that chart. As we cross that red line, it is literally the center line on the ice rink, and we are going deep into the zone here. We are headed higher.
You even got a hockey reference in there, Greg. That was awesome.
Right, and we won't be offside.
By the way, we're also long a Canadian gold miner, by the way. Well, it's actually a silver gold miner, KGC.
Yeah.
Yeah.
What's the first word in my outlook that I wrote, which is 67 pages. My God, I had a lot to say about this upcoming year, is chaos. And I think that's really the X factor here, is that and the second thing I say is try to put a square peg into a round hole. All these classic definitions that we have lived and died by, especially with an accommodative Fed over the last 40 years, and also very low inflation over the last 40 years, is changed. I mean, and so that's why these relationships, and by the way, if Tom turns out to be correct, what do we always talk about, right? You have to have risk management. You have to know when to take profits. None of us, I believe, are passive investors who just buy and hold. But nonetheless, I think that everything has changed here as a result of all of the non-credible monetary policies that have been put forth to this point, because all of the commodities were in underproduction, because demand needs have changed, because of anti-globalism, countries now and sovereigns have to beef up their own economies, because of populist type of regimes, which generally lead to chaos. I mean, this is a very unique time, I think, in history that we haven't seen maybe ever before, and that's why I'm hesitant to look at, and more in, definitely in Greg's camp, is that we're just like using that hockey analogy on the skating rink and we're about to go flying.
I think Greg missed an opportunity, an empty net goal. That's what I think. He went wide.
Connor Bedard and Commodities, same trade.
All right, guys, we're almost out of time, so I want to do some rapid fire questions if we could to finish off this market outlook. This has been a lot of fun already, and I'm glad we were able to bring up some of these longer term charts. It's really helpful to put things into context. We will start Tesla. So Tom, stop stalling, pun intended. Looking at the chart of Tesla, then we'll go around the horn. Is it a thumbs up or thumbs down here, and why?
I think it's your time frame, what you're looking for in your trade. I think if you're looking long term, 5-10 years on Tesla, you're getting a great opportunity. Could it go lower? Absolutely. But it did break down out of a head and shoulder pattern around 200. That measured to 100. We've hit the measurement. I think from here, I would be a buyer of the stock for the long term. Short term, I'm a momentum trader. I don't think we've seen enough yet out of Tesla. So I think it's more of a longer term buy.
Greg, do you think we've seen the bottom in Tesla here?
I own it for the first time in a long time, and I literally just bought it this week. And the reason I like it here is it's so oversold. We get some sort of a relief rally. Maybe it's 180, maybe it's 200, but if I can get a near double on that, I'd be just fine. So I like that. I don't care about the long term. I don't care. I'll ride the chart for the long term later, but all my charts are saying we're starting the next leg up in a bull market, and you probably want to be a buyer. And I think a stock like this isn't going to get left behind.
Mish?
Well, for consistency's sake, the Tesla stock held the 80-month moving average at 105, almost to the tick, which is exactly what happened in so many other the key sectors of the U.S. economy. So that tells me right now that certainly a relief bounce is in the works right now and could happen. Does it go at 150, 175? I don't know. But I would definitely say that if things do play out and the cost of goods get more expensive and people start to more penny pinch because they have to, then that would not ultimately be good for the Tesla stock. And we can break down under that 105. Would I want to be a buyer at some point? Absolutely. Do I believe in Elon Musk? As much as he's tried to shoot himself in the foot, I do think he's still one of the great innovative geniuses of our lifetime. So yeah, I'd keep an eye on it.
All right. Next question. Keep it brief if you could. Greg, we have the US dollar chart here. Non-US stocks starting to show signs of strength relative to the US. Would you be adding to your non-US exposure here or withdrawing it, and why?
Exactly. The US dollar is going to continue to go down, and that just matches up with other big bear markets ends back in 09 and back in 02. And so I expect the US dollar to keep going lower. Yeah.
Mish, would you agree?
I do believe that the US dollar will continue to go lower in terms of emerging markets. I think if they're commodities-based countries, like we've just seen a massive run in Mexico, that's probably not a bad idea to look at. There's a couple of global ETFs that could be interesting that give you exposure to a lot of different things. But yeah, I think the dollar going lower, though, is just another one of those thorns in the side of the super cycle of commodities. And you have to be wary of countries that could really feel a pinch or worse, go into some level of, war, not a civil war, a domestic unrest to a point where things become unruly, like what we've been seeing in Peru and even in the start in Brazil over the weekend.
Tom, would you add to non-US exposure here?
Yeah, I think in some areas, I actually, I like the DAX in Germany. I think, again, that's an index relative to the S&P 500 that had been downtrending for a while. It looks like that downtrend's broken and is moving back up. And the EWG, which is the ETF that tracks the DAX, I think if we do see further dollar deterioration, that adds to your value in the EWG. So, international stocks have been trailing the S&P 500 now for quite some time. And I do look for that change at some point. It seems like it's underway right now. So yeah, I think for the first time in a long time, I'm seeing some areas of international stocks that I would want some exposure to.
Yeah, a lot of the developed Europe markets look a lot like Germany, France, Italy, even and others, right? Having that nice rotation to the upside. What sector would you be most happy to be overweight, thinking, looking forward through the course of this year? Mish, what would you say?
Precious metals.
Got it. Okay. Materials. Tom, what would you say?
Well, if you pull up a chart of the XLY and go back like 10 years and do a 1 year rate of change at the bottom, 50, if you're doing a weekly chart, do 52 weeks.
Yep. Okay.
And if you look at where we are right now on the XLY relative to the S&P 500, I mean, we're talking since the bull market, this is one of the lowest levels, if not the lowest that we've seen. I think, again, we're going to have a reversion back to the mean. I think you're starting to see that now with Amazon and to a lesser extent, Tesla. And those are the two big names in the XLY. I think by the end of the year, this will be one of the top, if not the top performing sector.
Greg, what sector would you be most happy being overweight here?
Well, it's not so odd for XLY at the start of a bull market to break out. So I'll give Tom part of that one. But I would just say, don't ignore the height of that momentum wave in commodities as we try to change the world energy-wise. So I would be very strong in materials or energy, either one.
Opposite question. What sector would you be most happy being underweight here? Mish, what would you say?
Probably would be growth stocks at this point, until my theory proves to be completely erroneous, or I see a real shift in terms of how consumers are going to buy, and they're going to go from basic needs to more discretionary. That's kind of where I'm least interested in right now.
Greg?
I would say just stay away from the staples and utilities if we're starting the next leg higher.
Get away from the defensives. Tom?
Yeah, I'd probably agree with Greg on that one. I like the aggressive stocks in a secular bull market advance. I think that's what we're beginning again, extending the secular bull market that we've been in for 9 years or so. So yeah, I would probably say staples would be my least favorite. I would say that would probably be the one I would steer clear of.
XLY over XLP. You had to say that, Tom. I knew you would.
At both ends of the spectrum. But look how bad the two have been. I mean, if you look at it, the XLP has been such a big outperformer in 2022.
Totally true.
And if
totally
we're
true.
going back,
we're out of time, guys, but I do want to have one really brief question. Just give me a ticker if you could. If you had to have a portfolio of one stock or ETF for this year, what would it be? Greg Schnell.
Tech Resources.
What's that ticker?
TECK.
Perfect. Tom?
They're doubling copper production this year. So
I would say, I believe rates come back down. So I think, it's going to be something growth oriented. I really like Amazon. If I had to pick one stock here, I think that's one that I think is going to have a big year. And I would say from a ETF perspective, it would probably be the QQQ. I think that the underperformance in the fourth quarter gives us a nice opportunity there.
Mish, what's your answer?
Well, besides the obvious that we just spoke about, I think that if we're looking at an area, I love tech, by the way, it's one of my first top choices in my outlook. So I agree with Greg on that one. But really, another interesting chart to me is this floor construction, FLR. It's materials, and I think it could see a really good move up, unless, of course, the market falls apart. So yeah. That's why I like commodities still, because I think they can go counter to whatever happens in the actual equities market. But
this is quite a feel-good discussion about the commodity space. This is an interesting development. I'll look forward to seeing how these themes play out through the course of this year. Guys, we're done. This was awesome. And thank you so much for being a part of Charting Forward 2023. We'll do it again sometime, I hope, later this year and revisit some of these points and see how things actually played out. So Mish Schneider of Market Gauge, Tom Bowley of Earnings Beats, Greg Schnell of Osprey Strategic. Thank you guys so much for being a part of this one.
Thanks, Dave.
Thanks, Dave.
Thank you so much.
Folks, I'm Dave Keller, Chief Market Strategist here at StockCharts. Thanks so much for joining us, and enjoy the rest of 2023. We'll see you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.